groundbreaking articles and reports today related to the multifamily industry and commercial real estate. Welcome to the Gray Report. I'm your host, Spencer Gray. And if you're a multifamily investor, active, passive, somewhere in the middle, you've been in the industry for years, this is the one YouTube show and podcast that we really designed especially for you to keep you up to date with all the latest information that you need to have in order to make some really smart decisions. I'm joined again today by Dr. Matt Bosnakel, Director of Communications and Marketing here at Gray Capital. Again, fascinating articles. Looking at a piece from Commercial Property Executive, piece from the New York Times, Indiana Business Review, Axios, John Burns Research and Consulting, as well as Moody Analytics, as well as some regional opinions and just some, gabbing on. Matt and I. All right, let's get into the report. All right, everyone, welcome back to the report.
Hello.
Matt Bosnakel, how we doing?
Pretty great.
Wonderful.
Like I kind of wrote in the notes, it's a little bit of breathing room, and I had a lot to think about.
Yeah. There's always a lot to think about.
Yeah.
I do feel like there's a little bit of a sign of relief. I mean, you can call it there's two sides to the coin, but after last week's meeting with Jerome Powell, the press conference, FOMC meeting, keeping the Fed funds rate where it is, at least for now, I think while it was relatively anticipated, it's given some breathing room and a bit of an exhale.
Yeah.
And I think that it is dampened the idea of volatility a little bit, and I think there's at least a semblance of that we can kind of plan. Because there's still an idea they can bump rates up some more if they need to, which we have to watch inflation. But if not, we're pretty much just looking at a plateau for a while. Now the question is not where will rates go, but how long will they stay here?
Yeah. I think that it was a little bit nice, and I know because we covered this live. And
yes, we did.
We were looking a little bit at the S&P, like as the announcement.
Yeah.
And it's a little bit reassuring that it hasn't been like a crazy highs in the S&P in the wake of the pause. And, we discussed how it does seem like the economy is kind of champing at the bit and really wants to spend. It really wants to spend. And we haven't seen like the reckless exuberance.
No, I mean, the market has been, has been up, quite a bit. The S&P 500 driven by some of the mega cap tech stocks.
Yeah.
But Matt, I just want to just share this just real quick. This is the VIX, the volatility index. Look at that decline, over time, and we are bottoming out. So this is again volatility. This is how quickly the prices move, relative to how options are traded, and so we have a lot less volatility than we did. And even going back again, this was the crazy time, when COVID happened. No one knew, but the VIX now is at lowest that it's been since pre-pandemic. I don't know how many people are talking about that, but that allows people to plan. And again, just let's talk about the multifamily industry just for a second. Not that rates, we know exactly where rates are going to be, but compared to last year, Matt, when we knew that rates would be going up, how quickly was unsure, and by how much we didn't know, and if it made it almost impossible to do deals. And the risk of doing deals was so great because you could lock up a deal. It takes by the time you find the deal, you start making the offer, that process could be anywhere from 90 to 120 days. And where the interest rate can move between day one when you underwritten it and you talk to your investors and you take it to the bank to when all of a sudden when you get your loan commitment, you're now probably already under contract. Interest rates have gone up, your loan proceeds go down, and it's not the deal that you thought it was.
Yeah.
That was happening left and right. I mean, we had to contend with that multiple deals last year, and it was not easy. I lost 35 pounds or 30 pounds during one deal, and it was like I was still eating, but just literally racking it was literally the additional calories being burned because my brain was unable to be turned off. It was wild.
Yeah.
But that constant calculation, there's always things to think about, but that risk of things moving so quickly has greatly receded.
Yep.
And so now it's more of a question of, what we can now embark on this journey of price discovery that has just not been able to be flushed out. Challenge is there's still not a lot of deals on the market.
Yep.
And will there be a rush of the buyers? There's not a lot of sellers. There's not a lot of deals in the market. There are buyers.
Mm-hmm.
There's still not enough activity that takes place. And then, but there's still this dark cloud that we've talked about of all these loan maturities that are going to be coming due. We knew things would be relatively calm right now. And so are things good enough? And will there be enough capital, in October, Q4 of 23 and the first couple quarters of 24? Is there going to be enough capital to keep the losses down in that 15-20% range, which we think that it is probably currently?
Yeah.
Or will there be so many deals that come on the market because they just need to be sold? Interest rates will stay where they are. They're not going to come down by the end of the year.
Yeah.
At least the short-term rates. Maybe the longer-term 10-year and agency stuff may.
Mm-hmm.
Although, again, credit seems to be getting tighter, not looser. Maybe that changes by the end of the year. But if there's a deluge of deals, it could drive the price down another, 5-10%.
Yep.
But I think we're probably either way. We're probably anywhere between 3/4 and 2/3 the way down to the bottom in prices. I think we're more than halfway there.
Yep.
Maybe, probably. It's just, are we going to see another leg down, or is it just going to kind of sit around where it is until enough prices? There has been dislocation in the market, though. That's what we're finding interesting, and where we're seeing potential opportunities. So again, things are just not being priced correctly, and we're seeing, and I believe the opportunity is some high quality assets trading at relative discount relative to some maybe not as nice assets.
Yeah.
So we're seeing like properties in very tertiary markets trade for what would be an attractive cap rate last year, like mid fives.
Mm-hmm.
But then we're seeing really like nice stuff in a new location trading for similar cap rates, maybe more growth potential. And we're like, okay, well, we're not going to pay the 5.25 cap for the super tertiary deal if the deals in A markets, A locations are trading for just sub 5.25. I'd rather go to
really interesting though. That's revealing though that there are markets and they have made an adjustment.
Their adjustments the adjustments have been largely been made. I mean, again, go back to 2021, the cap rates were in the mid 4s, even sub 4 in some cases. So it's all relative to, cash flow, returns, and cap rates, and in the full financial picture. That's why you can't say there's no such thing as like, what's a good cap rate?
Yeah.
I don't know. What's a relative to?
Mm-hmm.
What's a good interest rate? Maybe can give you it's all relative.
Yeah.
What are the other interest rates? What are the other financing rates? And so a 4.5, 4.75, 4.75% cap rate could have made sense if you're borrowing at 3%, but we're borrowing at 5 to 6% today, plus or minus. And so that 5.25 looks very attractive relative to pricing. And this is again the challenge. Sometimes the basis, like the taking the returns out, but like what you're paying, like per unit, especially like relative to replacement costs. What would it cost to rebuild this?
Yeah.
All of a sudden, like those metrics start to look very attractive. Of like, okay, it's going to take. So this is it's called a relatively new build, not brand new, but relatively new. Built in the last 20 years, 2003 to now. It's going to build that again, and these numbers are moving in location and market and what you're going to build. But call it 175 to 225. In the Midwest on average. I think that's probably a decent range. Correct me in the comments if you're seeing something different. 175 is probably in the low range for sure. But probably close. But if I could buy something that was built like, again, within the last 20 years or last 5 years, especially at 150 a door. Well, that's at least a $25K to replacement, if not $50K to replacement. And if my rents are somewhat similar, I'm getting some good cash flow. So that's attractive. But if, again, you're paying $150 a door, that seems attractive. But if the cap rate on it is, five, low five still, and your interest rate is 5.5 or 6, your cash flow sucks.
Yeah.
So if you're a cash flow investor and you're trying to buy on actuals, it really doesn't work. And so you have to decide, what's the play here? Is real estate is always a long-term game. It's not about doing something quick, but you also want to mitigate risk by getting a handle on what you're speculating on and what is maybe you're speculating too much on. And if you've got if you're buying in a great market and there's good rent growth and there's good population growth, you've got a good story to say, I can go from very low cash flow to stronger cash flow, and we've got a very strong basis. And so when the interest rates change, we'll refinance, and then we can start kicking up some cash flow. But but there's also value traps out there.
Yeah.
That you have to be careful of, because there's pick up some high quality assets in high quality locations, but then again, there's value traps. And what a value trap is something that seems like it's discounted.
Yeah.
But and so you think you're getting a deal, but in reality, it comes back to you get what you pay for.
Yeah.
It's priced that way because there's no real growth potential. So you buy something that's cheap, but it stays cheap.
Yeah. This is when I was first getting into it. I was picturing like a C class, like buying something. What if you bought on a C class, really high cap rate?
Yeah.
But no. You're going to have to fix a bunch of stuff. There's people maybe aren't going to even come in to rent, and there's all these problems that you're buying.
Well, and like you're in a market, like if you're just in a market that just doesn't support pricing over a certain level.
Yeah.
Like if you're we were looking at a market that is historically very volatile, because it has a concentration of one particular industry. And so you could say, well, maybe the industry's changed a little bit and it's less volatile. And specifically, the industry is like RV manufacturing.
Yeah.
And I'm talking about like the Elkhart submarket.
Yep.
So there's a case of like, okay, no, they've diversified their manufacturing. They're doing all kinds of stuff. It's less cyclical.
Yeah.
But I'm like, well, maybe that's the case. But I know, because I was around in the last cycle, I remember deals in that market trading for 150 to 200 basis points higher cap rate. So like, while deals are going for 5% in a better market, bigger market, this market, they're going for 7%.
Yeah.
And so the idea is, so now we're looking at this deal recently, and the price per unit, the basis looked really attractive. Like, could not build up for that. That's attractive. But the only way to make sense of the returns is to get a decent low cap rate on the exit.
Yeah.
And, if you didn't know the market, you'd say that cap rate's very reasonable. That's actually a kind of a high cap rate. But if you know the history of that market and how it cycles, in at least the history, it's like, okay, but this market it trades at it trades at a discount on the cap rate. The cap rate's going to be higher because there's always this volatility. There's more risk in the market. When it's good times, you could like the rent growth's really strong and it's like it looks great, but then it goes the other way. And so if you decide, no, I'm going to go buy it because it's cheap, okay, that's fine, but like it may always stay cheap. Maybe not. And again, that's you're paying for the range of standard deviation. It could go up, it could go down.
What I think is a little bit reassuring is that at least things are getting cheaper, and that it seems like sellers are getting the message. And they're realizing that like if they keep 2021 prices or really even 2022 prices, they're going to be wasting their time bringing it to market.
And I think it's brokers are finally, they don't want the time. Now they have had a decent amount of time on their hand. Yeah. So they're still like, hey, send me a deal over. Let me give you give me a price. I'll see if I can find a buyer. But the brokers now, the reality I think is setting in. Yeah. And so a lot of their job now is, giving their sellers some realistic expectations, which has been a challenge over the last year of brokers, but they were put in a tough position because, they make these, they put out these opinions. It's called a BOV, a broker opinion of value. And it's basically the broker underwrites it and they tell a potential seller of like what we think we'll be able to sell it for.
You could find oil under it. Maybe there's a vein of gold. It's going to be really great.
Yeah. Well, they kind of put together like, hey, this is how we'll market it, and they're like, and we think that if we create some upside, if someone does a value add, we think the price can get to here, and they usually give you a range. So, but then those BOVs at some point becomes stale.
Yeah.
But like in past, especially today, but in past years and cycles, like the market didn't move that much. So like if a broker who was decent knew they were doing, gave you a price, at the beginning of the year, at the end of the year, the price would probably be relatively the same. Or you could at least look at like, okay, if we increased our net operating income and maybe it's a little bit more value, but it's about the same. Probably every, year and a half, 2 years, hasn't moved so much unless you've really done something to it.
Yeah.
But values have shifted so much. Values went way up, and everyone's like, "What is it worth?"
Yeah.
And then they're like, "That's interesting. Maybe I'll sell." And they're like thinking about selling. Like, should I sell? I don't know. Maybe it'll go up. And then all of a sudden, the prices started going down, and they started getting nervous. And they called the broker back, and they're like, "Hey, that BOV you did 3 months ago, 4 months, 6 months ago? I'm ready to take it to market. Do we think we can still get that number?"
Yeah.
And the broker, whose livelihood is based upon getting listings from sellers. Yep. Whether it's just to start that relationship, I want to get that listing agreement, get them exclusive with me. How do I do that?
Yeah.
It's not by telling them no.
Yeah.
Well, if you're good, if you are good at your job, you know how to say no, and you know how to say it the right way.
Yeah, exactly. And they're happy about it.
But if you're again, like you're trying to put food on the table, you see your business drying up, and you get a call saying, "Hey, can we still hit that number?"
Yeah.
You're like, "Well, we can certainly try."
Yeah.
Bottom deep down, they're like, it is going to be tough. And they may say it's going to be tough, but it's worth a shot and seeing if anyone else is out there is what they'll say. There may be some 1031 money out there.
Mm-hmm. I'm going to betray my ignorance here. You go to a broker, you're not paying them just to list it. They get paid when it sells, right?
100%.
Okay. So they're wasting their time. You're wasting your time.
But in the time where they have no deals, because in there they have to play it's a relationship game.
Yeah.
And so it's like, if I can get in one deal with somebody, it can lead to more deals. Or if I can add some value to you now, I know you're not going to sell it. Because we have broker people come back, "Hey, let's just do BOVs for you." And sometimes like, sure, sounds good. But sometimes it's like, you're doing it because you want us to give you, you can be like, "Hey, I got a price. And by the way, I've got a buyer." So they extended this process. They extended this period of just sellers trying to stick to those high prices because brokers were, again saying it's possible. Let's see. There's no reason to lower our price. Do you have to sell today? Well, I don't have to sell till later in the year. Okay, well let's let the next 6 months, see what we can get. And if we don't get anything, then we'll revisit. We'll see what's going on. I just think that has gone on for a year now, and brokers, the stale BOVs from one period to the other, those are washing out, and they're now so stale that even the sellers acknowledge that they're useless. And so I think we are. I'm feeling optimistic again. Like storm clouds still could be gathering, but like I feel opportunistic because there are so many different currents that are all happening at the same time, and tides moving in and out. I do think the time to take some like very calculated like action and steps, because again, like the level of peak fear, if that ever happens, or that's gonna be the time to move.
Well, and this is interesting because I was, and I always felt like it would be, it's unreasonable to think that there's going to be just like one snap of the fingers and then everyone's like, oh, that's the 20%, lower our prices 20%. We got to get real. But really, it is these series of kind of negotiations or alterations, or slowly moving down and down and down. That makes a lot more sense. But I do, the fact that sellers are listening is it is really important. I forgot to tell you this story before the show. I have a neighbor. This is, in the selling single family homes. It's a little bit of the same thing where homes are staying on the market. Oh man, gotta lower the price. And it's almost like, I was thinking the only way these things are going to get sold is if someone has a really bad day. They have to sell it.
But there are so few homes coming to market.
Yeah.
That's the thing. There was a couple articles this week, the base of in shock and awe that the housing market has been so resilient. I mean, how many articles have we talked about of basically it's like, the nail has been, hammered in for the housing market, and and we've got some
explanations here. I've got a pretty, I think it's a compelling.
Well, Matt, we've been rattling on too long just about, we see what's going on in the market. Got any questions about that? Leave it in the comments. Well, Matt, what do the other experts say? What's first report? commercial property executive, or where do you want to take us?
Yeah, let's go.
Take us on a journey.
Start with commercial property executive, because we're kind of talking a little bit about loans and interest rates. And this was coverage from Paul Fiorilli. He is the head of research at Yardi Matrix, right?
Friend of the show.
This is a really great article too. And he shared some of his thoughts as well, some kind of extra meta thoughts on the on this council, the annual conference of the CRE Finance Council in New York. So Paul Fiorilli went there, said what's happening, and he's coming back with a great report.
Did we miss our invite on that?
Maybe. It was in New York.
Oh, yeah, man.
He said, and this really frames everything. In LinkedIn, he said, maybe the most surprising part was how little panic there was. A bank regulator told me he was surprised at how optimistic panelists were. I didn't see it as optimism as much as calmness that comes from the fact that the Commercial Real Estate Finance Council has been through several downturns and found ways to solve worse problems. The group will figure this out and get stronger in the part.
And they just say all the money's made up anyway.
Yeah. It's a very nihilistic.
It's all made up. We're the ones that get to make it up. We're the bank.
What is money? Yeah.
I mean, I get that. That's a very not nuanced approach, but
fascinated by this calmness, especially considering, kind of the fervor and the anxiety elsewhere, and which is reflected in some of the other articles that came along.
Do you think, because I know on some owners panels, I think I talked about it once, that there was a little bit of like, I think everything's okay, until like one person will be like, maybe it's not okay, and then all of a sudden like the floodgates open a little bit, at least to some. But I have gotten the sense that people are playing their cards a little bit close to the vest, and no one wants to be like, our book is, because again, I assume a lot of those are publicly traded companies. No one's going to be like, our balance sheet, our book, garbage, dumpster fire. Like who's going to say that about their own business? Yeah.
And I did.
We're good. No, we're same here. We're very financially, we're very sound.
Yeah.
Sound.
I thought maybe related to the fact where, like, kind of if you move NOIs a few percentage points, somehow the valuations can be. There are some places where just a few percentage swings can lead to such a different swing in the success or failure of an investment, and it seems like they're in this moment where it's like holding a bat upright, where if you move a little bit, it can go like, but if you make these they're in this maybe small adjustment phase.
Well, it's all financial engineering.
Yeah.
And we've talked about how, like, if you're on the margins and a little bit of financial engineering is going to kill your deal, like, maybe it'll help. There's some deals that are on the margins like that, but the deals that are going to have problems, they're so far away from those marginal fixes. Yeah. But like, again, anything can happen with the stroke of the pen. I mean, we had a whole books of MBS securities that were bought up wholesale, no questions asked, at the last recession. So like, again, the money printer exists, and it can, if obviously you have inflation on the other side, but if the idea that if inflation is receding, or this can be done in an isolated. There are all kinds of tools that exist, and again, it is whatever the Crown says it is. And
awfully detached. Like I really did. I was telling you this before, and it's like the start of a Greek tragedy. It's like this expert hubris that's leaving them blind to the crisis until it's too late. There's this anxiety elsewhere, but they're really. I think. I mean, really, them being calm in this situation. The movie's already halfway written. Act 3's coming up quick. I don't think there's going to be a twist at the end. I don't think there's going to be like, well, I guess you just named it. There could be a Deus Ex Machina. Someone could just write it away. So,
you're making great points. We've seen this story before. I mean, just think back to the movie The Big Short, and near the end of the movie when I forget who was Steve Carell's Bond. Anyway, it doesn't matter. Was interviewing the guy from Lehman Brothers. And like, as Lehman Brothers is crashing, the guy still is saying that, no, everything's fine, and I'm buying more of it. And like, the captain's going down with the ship. In all these cases. And again, not saying the ships are going down. I'm just saying that if they were, you wouldn't hear it from these folks.
Their job. That's what I was going to say too, is like, is this like part of like the image of the banker? Like, are they? And I think part of it is that's
what
their job.
The SVB, the Silicon Valley Bank executive, said the week before.
Exactly. Yeah. Like, everything's right. I picture them as all like these John Wayne, like, there's a storm coming, but we'll be ready.
I don't take any of these bankers as John Wayne.
Yeah,
so I could be stereotyping incorrectly.
But I do agree. Yeah, they have an incentive to maintain this calm, and it's
anyway.
It's not like Mary Poppins.
No. But it because there are all these tools available. But until the tools aren't available, they don't work.
Yeah. What I think was striking in this was there was one panelist that said how much private credit is going to come up. I don't know, use the word rescue or just finance. Yep. And he says that debt funds are raising a lot of money. They'll be the ones to step up and take the banks' 50% share. He said banks will be back, but I don't see that in the next year or two. This panel is talking about 50%.
Yeah, well, it won't be us. It'll be somebody else.
Yeah.
It won't be us.
Yeah, exactly. That's to take a 50% share and then just have this calm demeanor. Doesn't make sense numerically. Now, I don't know how much of banks' total loans or their total business is built upon CRE, but this is the CRE Finance Council,
and that's the big. They're the big dog in the room. I mean, the banks. Yeah. That's where the debt funds are private credit. There's a ton out there. Mm-hmm. But if the biggest source of liquidity is in the market, again, the argument that there's going to be vastly more liquidity than there has been, there's going to be more capital available when the biggest provider of capital isn't going to be, is taking 50% reduction in the market.
Yeah. And they cite dry powder. And we've talked about dry powder the last 2 years. It's like, dry powder some of this dry powder is waiting for like this ideal, perfect opportunity. And conditions are not ideal yet. This has got to take a little bit of someone like a brave investor that's willing to look for kind of diamonds in the rough or whatever, or has a tolerance for risk or lower returns that is associated with the kind of private credit and rescue capital, that kind of stuff.
I do think though on that subject, and I don't think this is not necessarily a good thing for markets, but I do think there's a lot of, we talked about a little bit in the past, but there's some fatigue of being on the sidelines, and there's a rally in the stock market, again driven by big cap tech. FOMO is going to seep in. Yeah, and is that FOMO? Is it going to be kind of I'm trying to think, the technical analysis term of whatever situation we're in right now. I don't think it's a dead cat bounce, but like, is it a, I guess a bull trap? Is there a bull trap that exists, or whatever, something that exists that gives people some false set of confidence, and people start entering the market, thinking that everything is great, but also just because they're like, I'm bored. I want to do something, or I need to do something because of this dry powder is going to evaporate.
It does seem like the attitude in the economy in general is like we're waiting for the opportunity to spend a little more. Consumer spending is doing okay.
Yeah, surprise. Yeah, people still want to be.
It's like people are leaving. They're like waiting to enter, it seems. But
and there's so many different cross currents that again, that's why there is so much disagreement or non-consensus, generally in the market, which is good. There's a lot of, I think, good things that are happening. I mean, we have like real risk-free rates, and I think we're getting into price discovery. Mm-hmm. But I mean, it like, just throwing out another example, the student loan furloughs or whatever. What's the forbearance? Forbearance is supposed to be coming an end here in July. And that's a lot of renters. It's a lot of renters that all of a sudden they're going to have to basically adding another car payment on to a lot of folks.
Yeah. And not for nothing, even in that article that Paul Fiorillo, he noted some information from Green Street that finds office real estate values down 27% from March 2022 and apartments down 21%. I think that's worth a little bit of worry, or at least it kind of punctures the attitude of cool, calm, and collected that maybe permeated this meeting, and for good reason. It was a professional calmness.
Yeah, but I'm saying you just have to have the peripheries on one end. This risk and dark clouds on the other end. You have potential upside, and the dry powder comes. The rescue capital comes to save the day, or things are okay. Things are all right. And man, we've talked about so many airplane analogies, soft landing, hard landing. maybe there is no landing. Maybe it's a mid-air refueling.
Yeah.
Like
we can hope for that.
and again, mere weeks at this point, the calls were for, it was like 100% chance of recession, which we said at the time, nothing's 100%. So like,
and I still think about this a whole lot. They're calling for recession. They called for a recession.
But have we already had a recession? What is this?
Yeah, exactly.
What is this? We had 2 consecutive quarters of GDP declines, and they refused to call a recession.
Yeah.
Because there were mostly political reasons.
Yeah.
I mean, let's be real. It's optics. We don't want. What do you want to call this period? Just stagflation, just the mud.
Yeah, it would be. Yeah. It's definitely slower. I still don't think that people are in the same attitudes that we saw pervade during the Great Financial Crisis and like kind of the early teens, 2010s and stuff.
But we had a crisis. It was called the pandemic.
Yeah.
We had a recession then. So it's like, and again, that recession was kind of unrelated to, I mean, again, we did a hard stop. I mean, we put a wrench in the gear of the global economy, and then we tried to like jumpstart it.
Yeah.
And we're like, oh, we're surprised that the engine is like a little rocky and bumpy, and we shouldn't be surprised if it just like flutters out and we have to restart it again, or if it's like and it starts working. Both of those things are possible. It's how do you position yourself to protect yourself from downside, but not missing out on the upside. And multifamily is in a unique position because if you can find the opportunities to do throw off a decent amount of cash flow, the fundamentals of multifamily over the next decade are strong. The housing market, we are seeing the data of housing market resilience. There's so much demand. We've talked about there's so much demand. Two things are happening. I mean, a couple things are happening now, but in the face of rising interest rates, also in the face of new supply.
Yeah.
In the multifamily and single family side, I mean, occupancies are now starting to come back, or vacancies are creeping up because they're seeing so much new supply. We're also normalizing from the pandemic. But like, what other cold water could you throw on the housing market that hasn't been thrown? And it's just like, just dodging bullets. And it's just, I mean, it's come down a little bit. But I mean, how many sectors, if you don't look at the entire economy, if you look at sector by sector, where we've already had recessions, we've had manufacturing recessions. Commercial real estate is down 15-20%. Well, that's beyond a 10% correction. We're in the,
totally.
Different segment all tech has gone through a massive recession. So how many recessions do we need in different segments? And surprise, surprise, it's not falling into our typical textbook definition of recession, which we also changed.
Yeah, I think that, well, and I think what you noted there is really important. It kind of jabs with what I think is one of the biggest storm clouds that's looming over the economy. So I'm looking like, where is it? Where is this failure going to come from? A lot of people say the office market.
Yeah.
And this is what I was thinking of this past week is how does this looming implosion of the office market, which, it's still in process. It's but it's, because of 5-year leases, we may not see the full effects of this for, a year or two to come. But remote work has increased dramatically. I think that's part of what buoyed the home values, because home is taking on additional functions. And we see this in a couple of the reports that were published this week. But contrast the cool, calm, and collected of from the CRE Finance Council with the desperation that is noted in this New York Times article. It says, return to office reaches desperation phase. Just to make sure we're not giving the wrong impression here, there are people who are expressing themselves a little more passionately than those bankers. My favorite account, though, now this is just to preface this office article, is, and this is like the anecdotal account of back to office motivations, is not the one that says that middle managers are calling people back just because they want to boss around people in person, although that is often cited. I think equally speculative and spicy, maybe a little conspiratorial.
You return to this office, Matt?
Yeah, because it looks so friendly.
Mm-hmm.
And all of those have names.
Is it they probably have a daycare in there? Maybe that's why.
Yeah. Salesforce has character names too, and now any employees from Salesforce will probably know of Brandy the Fox, who's a marketing.
Yeah.
And I don't know any other ones, but
we don't have any. We don't have any mascots at Great Capital.
I know.
We've talked about it.
I feel like having 5 different
that's a lot.
Is too many.
That's to me. If you have one, I get it. And the annual mascot, like as corny as it is, it's very effective.
Mm-hmm.
It's very effective. So I think I've thought about for Great Cap. We've talked about this. I think they have a gray wolf. Because I envision those really cool shirts with and I bought a couple of them, but I want to have the Great Capital version of like the wolves like howling at the moon.
Yeah.
And then also we can be the wolf pack.
Ooh, that's good.
And I tested out at Maintenance Mania. Mm-hmm. I'm sorry to distract, but at Maintenance Mania, it's great. It's like wolf pack, and
so you have to howl. Yeah, I've done that.
Everyone to howl.
I've done that independently with my boys. It's really fun. It does build. There's something to a good old howl.
Yeah. So beyond Salesforce, man, if we could devolve any quicker, I don't know if it'd be possible. We go from work from home, talk about Salesforce, what their office looks like, the characters, branding, and then we're talking about
So I'm sorry. Back to what my point is.
This is my fault.
No. I will indulge this because I'm having fun too. But there is a take on the decline. People calling back to office. They are motivated perhaps because there is a class of office real estate owners that are exerting their influence through all available channels to get American workers anywhere and everywhere back to the office, because if they don't, they stand to lose a whole lot of money. That's a little bit more convincing, or at least, that's like a powerful force, but I still think both of those arguments aren't really getting at the real reason why people want to move people back to the office. And I spoke with you a little bit before this. I've been having trouble finding specific studies that tout and really nail down like numerically the benefits of going back to the office. Some of them there are some studies that go either way that say working from home is more productive. A lot of them, most of them actually say that working from home is more productive. But I do think that there are something. There's a factor of being in person and sharing ideas. And I think that really what's interesting is if this idea that we want people in the workplace in person follows a huge amount of research into like urban life and like shared proximity as a catalyst for innovation. And like, just to add another source here, there was an article published in the Washington Post this week that talked about the decline of downtown and how, the office is caught up in a lot of the benefits of downtown life, I think, are shared by office life. And I haven't just seen enough of a study that puts a stamp. You Google this and you will find a lot of studies on that are just like, no, work from home is more productive. And you have to do some digging. I haven't dug far and deep enough, but I've dug deep enough to know that the vast majority of studies are kind of from the standpoint of let's give to this work from home impulse.
I think you're just pushing for work from home more.
I see. That's the thing is I got paragraphs here.
I think this whole article. I think it's all. I think it's all conspiracy. Well, the workers.
On your point, I don't think that it is.
Workers of the world unite.
That's right.
Is that what's going on here?
Home office, remote workers of the world. No, because I do think that there is benefits to going in the office, and I think that we all we're aware because we go to the office. I think it would help to get away from the idea that it's a zero-sum game, either work from home or the office. I'd love to see something that looks on things like, okay, for instance, video meetings are a pain and they're annoying. So how valuable is that to a company? How much of a price could you put on that? On like the muting and the
meetings meetings in general, is a big and time and
exactly like sync. where you're in. But I think when you add that layer of kind of you're mediating it through the video technology where you have to unmute and mute and like you're interrupting someone accidentally and
Matt, I'm just thinking through again our experience, and we've worked on like a lot of projects together, whether it's like decks or whatever it is, and like there's a lot that can be done like remotely, and like you're working on some stuff, and I can see you doing it, and I'm working on some stuff.
Yeah,
but like we also will get to a point where like we just need to get together and just sit down and go through this.
Yeah,
and it usually takes place in like we could do it virtually, but like often is like, let's just sit down and go through it. And
this is personally, I am work harder when there are people in the room. I think there's something about accountability. And I think that there is just like, it is like a more motivating force than if you're calling them on the phone. There was an old job that I had, and the guy said, yeah, I could call him, but if you want to get something done, you go there in person. And we walked.
So we're here. Let's get this done.
Yeah.
So like, I'm gonna pop off, then move to something. It's like we're gonna end this meeting, and I'm gonna watch what you're gonna do.
That's exactly what I was just gonna say. That the times when someone wants something done in the office, when I get it done is when they stand in the office until I'm done.
Yeah.
And guess what? It helps. It is like there is this kind of unspoken obligation and accountability.
And I and again, it's maybe stylistic because you could probably do all that virtually. I could ping you on Teams or Slack or whatever every 5 minutes. Hey, give me a status update. Give me a status, or hey, provide a status update every X amount of minutes. I think that sucks a lot more than just being like, hey, I'm gonna be over here, and then I'll just walk over and
exactly to have that.
I'm not gonna say you're good, but
and you can quantify the amount of time to ping that person, to them to respond. And there's that buffer, and there, you can put a lot of money on that, I think. Yeah. And so I'd love to see, where that goes. But
it is so personal, and especially where you live and what your family and or just home situation is. But yeah, I think, I don't know if the surveys, I think we probably work from the office more than the average. Yeah. I don't even put us in the same list as Amazon working 3 days a week or.
Yeah. The average that I saw, it does seem like, 2 days at home or like there's something like that. And that seems so high.
And then so combining, this isn't what the article is about, but combine this with the 4-day work week. So you get one. So
gosh, no, I think one of those 4 days.
Do you have to pick? Do you have to pick?
Yeah, I know.
Because it's like, oh, we're going to do hybrid schedule, 3 days in the office, 2 at home or whatever it is. But then also we're just going to remove one of those days entirely. Does the day from home get removed or the day at the office get removed?
Yeah.
Why not 3 days? What 3-day work weeks?
And one of the data points that I did notice was the people that are hybrid work are a little, perhaps even more dissatisfied, have a little bit more trouble than the people that are all office or all work from home. Because think about it,
which is interesting because I've heard the anecdote is, well, hybrid's the solution. We all agree that it's some hybrid, it's some flexibility, but you're saying the data is showing that those are the most.
And I think that
happy folks.
I think it's the people, it's like the worst of both worlds, you know what I mean? Yeah. And it's the inconsistency. And I think that the problem with, at least from my mind, the problem with hybrid work is coordination. Like ideally, I want all the people that are going to be in this meeting to be here at the same time. But if they all have different hybrid schedules, then you're always going to be on a different meeting, even if you're in person.
It is nice to kind of know what you're going to get when you come to the office. Of like, all right, most people are going to be here, and one person's out on doing. You expect that 1 or 2 people are out doing things, but it's always a little strange when if I get to the office and it's one of those days that not necessarily people are working from home, but like people are just like out at properties or wherever. I'm like, what's going? The energy is just different. There was a video that went viral. Then it was on TikTok, and then I think it got put some articles about this woman, this girl. I think she's in New York City, coming back to the office. And she was like, "Oh, so many people are here." And she went basically around the office and like all these things we spend money on. And it's like, well, there's no reason for me to be here. If you're the only one, there is no reason for you to be there. Yeah, like if it's just you and maybe one other person, you're in different departments. Like, that. There's no point in that. But man, when the office is, when everyone's here, shit's getting done usually.
Yeah. Oh yeah.
Now, like, are there just distractions that is caused? Because then the Nerf guns get out or there's some discussion about whatever. And it's like, hey guys, all right. I don't say get back to work that often, do I?
No.
I just
ring a bell.
I ring a bell. No, yeah. I just turn around. I'm like, I just get back to the office.
Like a parental look, like a glare,
Yeah, a lot of glares.
But that ties into it though. Those little interactions, I think that's one of the things that I have heard cited as like these serendipitous interactions and exchange of ideas cannot happen with such frequency or value if you're doing it over Zoom or Slack or something that just takes so much friction.
And you have a family at home also. I don't know, I like the idea of being in 2 different places. Like if I'm working from home, I would like to at least every once in a while, like if I work from home exclusively And before, we were Great Capital got to where it was, we didn't have an office. I worked from home, or I would work from, the coffee shop or wherever. But like, you kind of need to get out of the house.
Yeah.
And it's nice to have a place like this is where like we go and do work.
Oh yeah. Yeah.
And I can do that. I can do this here. I can be around the people that are also doing that thing. And it's hopefully a decent environment to be in.
Yeah.
And then like, yeah, if I need to be at home, a tree fell on my house yesterday.
Yeah.
I have to go home.
Yeah.
And, and that thing that happened. And then, but I'm like, well, there's only so much I can do here because literally I have the tree company come and all this stuff. So it's like, well, I'm still do some work. It's all good. I think options, and not every business, not every person is the same. The way people work, the way people focus, and
I think that totally nails it. We can maybe skip the Moody's Analytics piece because it does talk a little bit about office values, and we touched on that a little bit in the discussion from the
Yeah. Well, what does it say? Just so I can say that we should talk about it.
So office values have fallen.
Quick take. What does it take to see
office values down 12.7% from Q1 2022 to 2023, which is a lot less than the Green Street estimate that we heard earlier.
So we've got a lot more room to fall.
Yeah, there's room to fall, and 40% is what the Fed defines as a severely adverse scenario. But the upshot to this whole thing is basically if occupancy goes down from 81% to like 77%, and cap rates go up by 500 basis points up to 7.5, then we're approaching the area where from peak to trough, we get a 40% decline. It's not impossible, they say, but it's hard to get there. My point is, we may not be quite so far away, given the fact that the office leases are longer term, and we still don't have an accurate reflection of how current work from home environments are affecting the leasing decisions that companies are making for office property. So the story's not quite written. I do think that we have a long way to go if we're going to get to 40%. We don't need 40%.
What are you going to buy what are you going to do with your discounted office buildings?
I know. Turn them into water slides going up from one to the other. Earlier here, we will see articles written. So here's what's going to happen. A place like New York Times or Wall Street Journal or maybe Bloomberg will write an article about office multifamily to office conversions, and it's like, here's why they don't work. It doesn't really work. And then 2 weeks later, we will see an article written about, hey, we should do multifamily to office conversions. We're going to see that. We're going to see a disproving article and then a naive article, and then it just is going to continue. People are going to keep talking.
And those have already been written. There's going to be more of them.
Yeah, there are going to be more of them. But it's because there is this connection. One of the things I think that's driving the continued demand of the housing market is because the housing is taking on this new function as a workplace. And I don't think it's a zero-sum game where one gets to the other, but it is interesting how these things are interacting with each other. Yeah. And it is a factor that I don't think that should be really ignored as much.
Some conversions will work. Most do not. It all depends on the price.
Yeah, that's a good point.
And you go down 40% value, that allows you to do quite a bit more than we could do today. And so again, the pricing maybe today doesn't work, but if the values decline another 20%, maybe they make sense. Or all of a sudden you're getting in at the price of basically the land and you just knock it down, you just build up. Yeah. I mean, and that's going to be a lot of the case, but some of the conversions will work out. Again, it's a matter of cost, and maybe they're not going to be apartments, maybe they're going to be whatever.
Yeah.
But it's the unfortunate reality is, there is still demand for office space. There are still office leases being signed. Yeah. But they're like exclusively for like the brand new Class A spaces with all the amenities. Just as an example, a local example down the street, Matt, the Bottle Works Phase 2, it's a big development on the north east side of Indianapolis. Well, Bottle Works District, the whole, historical revitalization of this old huge Coca-Cola bottling facility. First phase is really great. Through this phase 2, initially they were going to build apartments and condos. Yeah. It's all office now.
Oh, really? That's super interesting.
So much demand on the office side. Retail on the bottom, office, the rest.
And that's another story that we talked about a couple weeks ago. And it's interesting that it's office because
they made they're like, no, less multifamily downtown, more office downtown.
That's super interesting because people want to go where people still want to go.
They want to be in a cool spot. Yeah. If you do, so if I'm a business, all these businesses are like, we've got our 10,000, 15,000, whatever square feet, we're going to downsize from 15 to 10 or whatever, or we're going to keep it the same. We've grown, but we're going to keep our footprint the same. But where are we going to go? Okay, if we're going to have a smaller footprint or the same, let's get something a little bit nicer.
Yeah.
Do I want to go to this old building that just kind of like looks like, office space, just cubicle farms, no amenities, or there's a place down the street that is about the same, maybe it's a little bit more, but it's got a gym, it's got amenities, you're in the thick of everything, it's cool, it's modern.
Yeah.
Sign me up. It makes sense. I mean,
they're kind of like lifestyle renters.
Yeah. I mean, so people will comment. Yeah, it is. It's a good point. They're renters by choice.
Yeah. Yeah.
And we're an example of this, Matt, a little bit. I mean, people say that, and I think we've got a cool office. People will be like, you guys have a really sweet office. It's really unique. And we're paying the same here that we could have paid for some kind of generic office space.
Yep.
The timing was right, with COVID and everything. It was a unique opportunity, but we're not like paying up an arm and a leg to be in this cool spot. It's just we decided we want the fit all costs the same, all the nicer stuff, and the timing of we can get on TI and all.
And I think that there is also countervailing force, a pull away from downtowns, maybe into like suburban offices. But there's some interesting shifts, and like it's gonna be. There's definitely some room for at least volatility in the office market, and so that's just I was thinking about this. I was thinking about, I told the story a couple years ago and talked about how huge the housing affordability crisis was.
Yeah,
and we were like, it could power through the pandemic, any crisis and guess what? It did.
It did.
And I'm thinking, what if this
office gets through?
Yeah. No. What if the office is an equally powerful force, and if it's just as powerful or maybe more as the housing affordability crisis, there could be a really on the other side, on the negative side, whereas housing is on the positive side for demand. What if equal and opposite, like if this negative side from all that? I mean, what's going to happen?
And I think that is kind of the base case right now.
Yeah.
What I also think is interesting is, and again, BottleWorks is an example. What are those wedge cases? Where are those opportunities of work? No. This is a huge opportunity because I can maybe buy the office building at a discount, but I keep it as office, but I just make it awesome. You add the amenities, you add all that extra stuff, and if it's at the right location, maybe you can make something happen and add a lot more value than trying to force a round peg into a square hole and turning it into apartments.
Yeah.
Maybe it's, I don't know.
That's true. And it's not a monolith. And just like every market's different, there's definitely going to be you can't just write it all off. But I think that there's a massive wave coming, and we talk about the loan maturities coming, and offices is part of that. There's reasons for bankers to worry, I think. But on the housing side, and so this John Burns Research and Consulting article was, I think, really valuable. Actually, takes a longer term look, and I love the end of the article because you don't read it. He just says, you scroll down to the end, and he says, expect solid demographic housing demand through at least 2030. So that's it. That's the article. But how they get to it and the reasons that justify there. If you want, if you're smart like us, then you want to know that. And there are reasons. One of which is population growth. That we may not have enough to drive up housing demand, barring changes to immigration policy. And that immigration part is my addition. But housing formation, really more than population growth, is the big thing that perhaps will drive people. The more people are peeling off, they don't want roommates, they want their own place. And that means this growing adult population means 18 million more households by 2030. Supply, we talked about how, yes, they are building, but it's still not good enough, especially in this high interest rate environment, which is making, I don't know if it's driving up replacement costs or lowering supply, but it's definitely meaning that we're not building right now as much as we should be. And then finally, work from home. This the home is a more valuable place, and people do more in it than just sleep now. And so I think that played into early in the pandemic. There was a desire for more square footage. I think it just also has a discrete impact on the amount of money people are willing to pay for their home. is greater if they are going to be doing more stuff in it. They're spending more time in it. It seems intuitive, but I don't know. I just hear from the reports.
This is a good report, Matt. Because it does kind of hit straight to the point. I mean, growth in the age 35 to 49 population is going to drive household formation, especially in the suburbs. I mean, and there's a big part of our internal investment thesis that is really kind of centered around that demographic fact, and that a lot of these people will be continuing to rent relative to the cost of housing, cost of a mortgage. And let's go sort of full circle on all of this, Matt. We're just talking about how resilient the housing market is.
Yeah.
There are millions of millennials in this 30 to 39 year bracket who are waiting to get into the housing market. They can't afford, it's not an option right now.
Yeah.
And that they may never come or may not come in the near term the way they think.
Yeah.
And they may be a renter for a much longer period of time. And it's hard to know kind of where that line in the sand is.
Yeah, extending that time.
It's millions of more renters. It's a lot more units that we need.
That's a good point. For the economists and the projectors of housing demand or apartment demand specifically, is we may need to alter the calculation of the expected amount of time where you remain a renter is longer now. There's not even houses to buy, and what.
Even if you want to buy a house, I mean, the couple times that I've gone just curious to see what's on the market, there's not even thing. It's especially in the ranges that you want to look for, you want to spend. It's like the values, and again, like I haven't watched.
It's easy enough so that like a hobbyist that just like keeps track, like my wife and my brother actually, and they'll look at houses off and on, and it's enough that you will know all the houses that are on the market. It's probably possible to know.
No, I know, seriously. It's like there's
one. Yeah, I saw that one.
Especially if you're like within a price range.
Yeah.
Or within, the 350 to 600 or whatever, 800.
Yeah. You'll know the specifics because there's so few out.
There's only a handful.
Yeah.
And then you look at like the house you would get, and it's like not any. It's like more expensive and not as nice as your current house. Like, what's the point?
Yeah.
Because Alex and I, we were looking at, possible addition. I'm like, well, if we're going to spend this money, what else is on the market? We should at least do the due diligence and see what else is out there. Because like, it's a lot of time and work. Then looking around, we're like, the options that we think are expensive, like are downgrades.
Yeah.
So
it's crazy.
Yeah. And what we'd have to spend, and it is.
So that Axios article actually does repeat a lot of the same, but just know that it supports everything which is. They cite NIMBYism and regulations that prevent more houses being built, lack of home building post great financial crisis, which we kind of covered, and the work from home increasing the need for space as reasons for this housing shortage. Now, the Indiana Business Review article, which cites kind of this general uncertainty in the national real estate market. It's palpable. It's palpable. This kind of through an interesting ingredient here, the idea of psychology. And, it does talk about family home prices that have plateaued, sales are down. Home price to income is sharply up, which I think is a reflection of this changing function of the home. And it also does reference these supply issues. But again, back to this kind of the psychology aspect. They speaks to this human motivations behind these real estate trends a little more than Axios or John Burns, and it maybe suggests that people were panic buying during the pandemic. I'm not too sure. I think that there was certainly an exuberance associated with home buying, but I also think that some of it is related to the home as a workplace. But finally, maybe the most interesting point was they talked about interest rate increases. And, even though the interest rate increases make it feel pretty uncool to be a borrower right now, the relatively small spread between the Fed funds rate and the 30-year fixed rate suggests that lenders have some confidence in the housing market. Just like Paul Fiorillo said, they're not worried. There's nothing to worry about. Everything's fine. So that's the graph right there. And it shows, even as interest rates have risen from the federal funds rate, that spread between that 30-year mortgage and the federal funds rate has been shrinking. Now, we typically when I talk to you, it's a spread between the 10-year and in the 30-year, or am I really off base there?
Look at any kind of spread you want.
Yeah, all right.
Might tell you.
I'm just wondering whether that relationship does reflect banker confidence, or it's simply, or we should use another comparison to be basing our spread.
That's a good question, Matt. And I do trust the authors. The author Sarah Coors of Indiana University, Center of Real Estate Studies. So I are there others? I think it's good.
Yeah, well, good. But if anything, though, I mean, it totally complements and like really supports this. Well, the bankers weren't nervous there, and they don't seem to be super nervous in any of our discussions. Now we can speculate on whether that's the beginnings of a Greek tragedy or not, but they're not pulling their hair out. The people that are pulling their hair out are probably it's going to be related to the office market. The closer you are to that, maybe. Still low median days on market. People are still buying these houses. They're still, the demand is still robust, and that was, to put a pin in the discussions today. It does seem like there's nothing that can stop this housing demand.
Yeah.
And my big unanswered question is, how will the problems in the office market affect the lending situation, the investment situation, the general economy that's associated with multifamily market? I'd like to think that it's great. It would be great to think that the office's loss is our gain. But the reality is, if there's troubles in the office, it's going to make it a little bit tougher to get a loan for multifamily property.
It probably will make it easier, and it's so hard to know. I think it's a time, as it is always the time, to hope for the best, plan for the worst.
Yeah.
Keep your one eye open for the weather, as always. And make smart decisions and just be on top of like the right information.
Yeah.
Which is why we do this, every week, is to try to look at what the new information is, the quality of it, just where it kind of fits into the narrative, and just and try to paint a more clear picture and add some color. And certainly, even though we can give you our opinions, and if you've listened to this episode, and you've heard me say, I could believe very strongly that we could see a big disruption and crash.
Yeah.
We did a whole report on the possibility. I also can see a very clear path to things working out really well.
Yeah.
And I don't think you have to pick a camp. I don't think you have to pick a camp.
Mm-hmm.
And I don't want to have to be like, yeah, no, I'm in the doom and gloom, or no, I'm in everything is fine. I think both of those are possible outcomes, and the probabilities literally change every 2 weeks. So again, to think that we're going to know now, the new data is going to come in. So I think we have to take a very dynamic approach to this.
Yeah.
And we do have some more certainty. We have some more data points than we did a couple weeks ago and months ago. So I think we can start again. That makes the picture come into focus slightly. It's just more important than ever, Matt, to make sure you're subscribed to the Great Report.
That's true. Yep.
I mean, frankly, if we don't talk about the people who are subscribed to the newsletter and the channel as much as we could,
you're right,
because that's not the point. But the leaders of the industry, again, I think well over 100,000 units are represented by the folks that read this newsletter, and we've had the brokers and the actual industry thought leaders. This is it's a critical tool. And if you're not signed up, greatcapitalllc.com/newsletter. Make sure you're subscribed to this YouTube channel.
Yeah.
And we've talked about some of the reports that we've released. You can go to greatcapitalllc.com/report to check out our latest report that was released. Very interesting. It's been picked up. We're doing some other interviews this week about it, Matt. It's exciting. We have time for comments.
Yeah, let's go through some.
Let's do some comments. So again, leave a comment below this video, because we not only do we respond, but we talk about comments on air. And if you have a halfway decent comment, it's gonna get most likely featured. And again, bring it on. We want to see Like, call us out, what we got wrong, what we got right, and then like just give us like your opinion on stuff. That is good. That is good too.
Mm-hmm.
All right, Matt, let's look at some of these.
All right.
First off, loan maturities distress in multifamily market. We got to thank you. You're welcome.
Mm-hmm.
You're welcome. I'm gonna just do a quick one of these, Matt.
Ooh, nice emoji.
It's cute. A little conversation with Christian Rooney here. He's basically asking, do you think the banks will sell off notes to save balance sheet?
Mm-hmm.
And we responded, some are already doing it. Most are trying to sell closer to par. It'd be more interesting at discount. So this kind of comes back to, and you responded then, they're assuming there's no black swan. This, Matt, is really getting back to this idea of, again, the banks aren't going to like showing their cards too early. But are they doing things in the background? Like, yeah, absolutely. A lot of conversations, but there's no like announcement of.
Can you explain what he means when he says banks will sell off notes?
Yeah. So the banks, providing mortgages to these properties. So they've got on their balance sheet, they've got all these loans that they made. They're all assets on their books.
So they can sell that.
Yeah, I'm going to sell you. So it's an asset. Piece of what? It's an so I've got this loan. I've given you a loan, Matt, and you owe me money.
Yeah.
But I can take, so that loan's on my books, Matt, boss not owes me money. I've got an IOU from you. I can sell that IOU to someone else.
Okay.
And so, but they're like, okay, the IOU's worth $1. And they're like, hey, you want this IOU? I'll sell it to you for $1. Other banks like, can you sell it to me for at least 99 cents?
Yeah. So then the act of selling is almost like it's going to be less.
Well, that's if you're a buyer, you want it to be less. So right now, the banks are like, oh, it's a good loan.
Yeah.
No. We just need to. Everything's fine.
Yeah.
Everything's. That's why everything's fine.
Okay.
It has to be if you want to sell close to par.
Yeah. Because if they started looking, then you would know that. Why do you want to sell?
It's like then all of a sudden it's like, yeah, we'll buy it 50 cents on the dollar.
Yeah. Okay.
Then how bad then you get off on their books?
Yeah.
Again, there's gonna be a lot of that on office, and then people are gonna want to keep the good stuff on their books, good multifamily, but. May or may not be able to.
I've heard multiple. It's not just you. I heard it from you first, of course. Banks don't want to run the buildings.
No, they don't. They do. Yeah. They do not. Especially if it's distressed. They're on the property management game. They're on asset management game.
Yeah.
Like, I mean, and it's not. People are like, oh, it's fine. Can they just hire an asset manager? Yeah. And no, it's not that. It's not.
They know, and they know enough to know that it's not for them.
It's a different area of the risk spectrum. It's not where they operate. They're like, we give the people the money to do the things. We aren't the ones that do the things.
Yeah.
The only thing we do is
They would try if they were a little dumber. They'd try. But they're smart.
Exactly, Matt. Exactly. Christian, another comment. This is a couple of weeks ago. Do you think there'll be distress in your markets? We're in the Midwest, specifically Indianapolis, where we're headquartered. Where are caps now? Where do you think they'll be in 24? So again, this is like straight down to it. And then like a lot of groups would be like, I can't give you that information. I'm not going to answer. But no, this is us coming right back. There will most likely be some pocket of distress in most markets. The Midwest should see less distress than some of the higher profile Sunbelt and coastal markets. Cap rates are in the 5 to 6% range today. That's the range. In 24, they could range from 5 to 7 before compressing. That's what I'm saying is like they could stay the exact same, or they could, and before compressing again. So they go up, they come down.
Yeah,
we don't know, but here are my thoughts.
A lot of the like projections that I'm reading seem to all assume some sort of normality that coincides with 2024. Yeah, like we'll see the rough unemployment or inflation or interest rates or whatever.
We got to get over.
Yeah.
And unfortunately, I'm gonna have to run here in a second, but a couple more. What an incredible! So this is August Binyaz from CPI Capital. What an incredible story about the investor. As always, you guys hit it out of the park. We really appreciate that, August. So this story, you can go and watch the video yourself. We're telling the tale of the massive foreclosure in the Houston market of Apple's Way Capital. They bought a bunch of deals in Houston and unfortunately had the foreclosed upon, had to hand them back in the bank, really ran them into the ground. It seems like, according to reporting, and we had a little bit of a personal encounter with it, someone that was involved in those deals. We ended up telling the investor that we weren't a good fit. We ended up not want to work with them. They went with another group that ended up totally screwing the pooch. And it was a big Wall Street Journal article And we just go into the details of our interaction. And we actually tried to warn this individual of the way that they were picking a sponsor to expose them to quite a bit of risk.
Yeah.
Obviously, that message was not received. Okay.
Oh, I missed this.
Cynical Indy 1434. So this is a local comment.
Yeah, this is about a month ago.
This is
I didn't
good one.
I didn't hear about this.
Unless I responded to it.
Yeah.
See, that's the thing. I'm not even having Matt do it. I'm doing this myself, guys. This is why I like it. All right, this is good. This is good. Okay. All right, we can pull this one out. Okay, Cynical Indy 1434 4 weeks ago says a roof over one's head can't be compared to the same supply and demand as produce. I think that we were talking about basically what I was trying to say is, there's a reason why we're talking about needs, and people say rights. And I'm saying, well, you need to eat to survive. So we're saying housing is human right. Everyone needs housing. Well, you need to eat as well. Yeah. And so, but we don't call food. We don't control the prices of food.
Yeah.
And then a roof over one's head can't be compared to the same supply and demand as produce. People can do without an apple. Everyone needs a home. So take the humans out of leasing, base rents on market-based algorithm. They use the same software to set the market rates. Okay. Meanwhile, more and more people face homelessness or deranged strangers that become your roomie overnight. SMH, shake my head at us, Matt. So I responded, and I'm not trying to get into a big debate with folks, but again, if you ask the comment, we're gonna respond. I said we would argue that food or some sustenance is a necessity for life. Yeah. Right. Is that am I off base?
Yeah, that was a little bit of a crack in the argument there.
And I hope we can agree on that.
Yeah.
You do need food for life. And because their point was that it was, and I don't know, is that a straw? That's not a straw.
No, I think that this person could have made a stronger argument and did not make a stronger argument. I want to help that person, but I ain't gonna.
Yes, I agree. Yeah, there's a much sensible argument that could have been made.
Yeah.
So just like there are social programs to address hunger, there are others to address housing affordability. Saying there's people in the market. We separate these into different categories: affordable or subsidized rent, and then market rate housing. In this case, we're not specifically speaking of market rate housing. We are speaking specifically of market rate housing, not affordable. What we may not, or maybe we do, I don't know, agree on is that the efficient markets are the best system humans have discovered to allocate resources throughout society. Is it perfect? No. Is it fair? Usually not. However, it is the better and most fair system that works. Suggest another one, and I'm open to listening. That's all I'm saying.
No,
I don't know.
No,
I thought
makes sense.
Reasonable. Okay, let's just. I said we haven't replied to this one, Matt. We're gonna have to get back to food by the word 6262. AI is here to stay. Yes, indeed. We are using it almost daily in our firm, and it is a game changer. In the business development industry, I am spending a lot of time attempting to get folks to understand that the future is now.
It's getting close.
Yeah. And the more and more I use it, I'm like, we're getting it.
Yeah.
Now I'm like, it's a tool. It's not like
it's a tool, and makes me feel a little bit safer about the robot uprising. It's not going to happen this year.
I kind of do.
Yeah.
Okay. So Christian, you wanted this from a month ago. And I guess we'll do two more. Just because August, the other one. Yeah, what a joke. If you get high credit score, they can and this is talking about Fannie Mae, why the Fannie Mae was pushing a very specific narrative. Yeah, what a joke. If you get a high credit score, they charge you more fees. If you're in foreclosure, they won't value out or make the bank supplement and cut you a deal with you. What a joke. Our society is becoming socialism.
Trying hard.
Yeah.
They're trying hard.
Yeah, they're trying. Okay, and then August, Binyaz, again, from CPI Capital, saying, host a conference in Indianapolis to bring your awesomeness to the market. I need to get a speaking spot for suggesting the idea. Well, August, obviously, you got the speaking spot. If we do it, we've talked about a conference. I don't know. We've been easing into that because, and this isn't to get too meta, but we have hosted a couple events. I mean, first, getting investors together, just appreciation, or we did a thing at the track. We did a little networking event, at the Bottle Works District 2 weeks ago. But we have to ask ourselves, and this is just something that I'm trying to be aware of, is just what business are we in?
Yeah.
And events can be a great form of marketing and it can serve a lot of areas of the business, but like, I'm not in the event planning business. I'm not in the conference business. I'm going to make a lot of more money, and our investors are going to make a lot more money with us focused on buying apartments and managing the apartments. And that's where my focus is. Now, could we do a conference and all those things could still happen? Probably. But that's why it's not the top priority. And that's the same reason why, like, I haven't gone into like coaching or anything like that.
Get your eye off the ball.
Yeah. Because then I know, because if I'm going to do the thing, I have to allocate a lot of time to that if we're going to do it. And I don't have like a ton of abundance of time between, running great capital and then, family and anything else I want to do in my life.
You can just not be present for your family.
There we go. I think they'd have a comment about that. And then I think we've covered the rest of these, Matt.
Yeah, I think so.
So now we've, so I mean, maybe not thousands of comments, Matt. I mean, if we're rounding up, we're
responding to each one.
But so drop a comment below.
Mm-hmm.
I mean, not only do we left comments to the vast majority of those. There was one or two that we missed, and we'll do a little written response. But we will eventually talk about your comment on air. Mm-hmm. So again, you've got folks in the top percent, what fraction of a percent, not only of like net worth in the country that listen to this, but folks in the multifamily industry that are real game changers, deal makers. And if you want to say something smart or not smart, this is the place to do it.
That's right. The town square. We're the new town square.
It's true. People
in the comment section.
People come saying, I need to get on the Gray Report because I've got something to say, and it's the only way that's going to get out and viewed through the lens of objectivity.
Yeah.
And I think that because when we come in here, Matt, we don't say, we have a narrative we're going to push. We have our biases, like we have our biases as everyone does. Mm-hmm. But we have not been saying everything's good, everything's fine, or just keep investing. We're just like, no, this is what we're seeing this week.
Yeah.
And this is how in real time, how we're making decisions and how we're addressing it. And it's going to change, and we may, and our perception may change as well. Mm-hmm. But we're right here with you, figuring it out, bringing the best, highest quality resources and information. Sure. And then let's try to make some sense of it, have the conversation. We're not going to get it all right. But we're going to try to get a little bit closer mm-hmm. because we have a little bit of a clearer view.
Sometimes I've been wrong, but that's called learning and changing, and try to get as close as we can.
Exactly. So we appreciate you being on this journey with us, watching the YouTube show, and listening on the podcast. We very much value you, and thanks again. We'll see you on the next episode of The Gray Report.